When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone. Welcome to MacroEdge Radio number 33. This is John Galt speaking, and it is Friday, December 20th, 2024. I hope everyone can hear me okay because X has been a royal pain in the proverbial ass all day long. Don't ask me why, but sometimes when you speak out and say things that are a little bit, shall we say, questionable, they do tend to sit there and slow you down, restrict your ability to use certain aspects of the software, and create problems for you. Today, before we jump in with our special guest, Vinh Vuong, I want to go over the markets. It's a quickie because this has been one of the wildest weeks we've seen in a while. We're finishing with a bit of a dud today, if you want my opinion. Going in at 401 today, Dow up 497, NASDAQ up 199, S&P only up 63. Compared to the drops we saw Wednesday and Thursday, that's not really going to put a dent into it. Volume is better, but not nearly as solid. For those of you that do not pay attention to this show, the blog, or the MacroEdge team, a quick bottom line, as we discussed last Friday, and I apologize for not getting that show up to everybody. This is year end. Monday, there will be some moderate trading, but pretty much we're winding down for the holidays. Most of the guys are boarding planes for St. Bart's, heading to their ski chalet, going to Europe, or taking care of business with family. The reality is that there's no serious trading after Monday. It's the junior Power Rangers and all of the retail schlubs who get taken to the cleaners when they buy crazy things like, I don't know, unicorn fart dust, the latest in the crazy meme coin insanity. WTI crude down 108 to 69.52. Brent up 6 cents to 72.94. The Widowmaker natural gas up 18 cents to 3.76. It's a little cold outside, so I'm sure that we're going to have some people thinking this is the best time to invest in it. Good luck. That's all I can tell you. Gold up $35 and a bounce back rally at 26.43. Silver up 71 cents to 30.11. And with that exhaustive and quick summary of the markets, we're going to introduce Vinh here in just a minute. The biggest issue I see is a statement. I was watching Bloomberg, which is a bad habit of mine. Some days I want to just stab my eyes with a fork. And there's Nancy Tingler from Laffer's firm making the following statement. And I will start with Vinh on this one. Quote, "We are in the early stages of a bull market." Vinh, welcome to MacroEdge Radio.
Thank you for having me.
That one? We welcome you aboard, sir. Please explain a little bit about what your work is, your firm, and where they can find more about you. And then we're going to go right into the macro and market picture.
First things first, thank you for having me on. And number two, she's an idiot. And I'm happy to debate her on Bloomberg. I go on Bloomberg all the time. So I think she's lost her damn mind, as well as the other folks and investors in the markets. But I'm Vinh Vuong. I am the founder, chairman, and CEO of Garrison Fathom. We are a holding company in where we invest from a private equity level, at a VC level, as well as we have our fund, which is the Sagacity Fund. And we are a micro long only fund, and we invest fundamentally. So we do things the right way. We provide low risk numbers with high risk returns. Our Stratino, I think, hit 5. Our short ratio is 1.7. Meanwhile, we're up 70% year to date, and that's just not anything magical in the back end. It's just understanding the microeconomics, understanding what's going on with real numbers, keeping it black and white, and making the right investment decisions, studying properly with the right companies, and then buying and holding, understanding that the markets go up and down. And the only time we change our mind is if there's something really pivotal changing in the world, just like with COVID in 2020. So briefly, that's what we do. Hopefully that's a good explanation. And thanks again for having us.
Well, I appreciate having you on, and believe me, this is the kind of information people need to understand. When you're a fundamental investor versus a technical or speculative investor, if you could explain the difference between the three, because we see a lot of the speculative investors all the time on television. It's wearing, it's tiring. It actually does sit there and drive the wrong message. Would you explain the difference between those three types of investors real quick for the newbies? Because we do attract a lot of retail and casual investors in our audience.
Yeah. So the three different type of investors that you explained there, the fundamental investor, I'll start with that, which is us, is we actually are stock pickers. So we actually, we actually look at what's going on in the world from a micro level in the economy. We look at economic numbers. We look at what's going on in DC and around the world with policy making. And then we see what the trends are. And then we actually look at actual companies. So we treat stocks as actual companies. So a lot of people, which are the other two type of investors, they just speculate, right? They just go, okay, these are the trends that's going on in index funds. And that's how they invest. And then they try to do fancy numbers and quantitative things. And they try just to make bets and all the sorts. And the third type of investor you mentioned, they just kind of, they just kind of gamble. But I'm sticking to fundamentals, because the fundamental investors, what we do is we actually study each company. We look at their management. We look at their numbers. We look at their products and services. We look at the trends for those products and services. And then we look at, do consumers or their customers actually demand it? Is there innovation going to happen within that space? And how are policymakers going to react to them? Is there antitrust issues? Are there laws that are going to come into place, or legislation come into place that's going to affect them? And at the same time, we also look at, okay, are they going to exist in 5 to 10 years, right? Are they a company producing things that people actually want and actually need? That's what's really important. And that's what drives me nuts about a lot of folks and our peers in Wall Street, is they tend to just look at stock as a stock and actually not looking at it as, what is that company? Or what is that commodity? Or what are they actually trading? Again, like the other two type of investors you talk about, the speculative and all the others, they're just gamblers. And that is becoming a huge problem on Wall Street, and has been for a while, ever since the quantitative easing. Thank you, Ben Bernanke. Is people tend to just gamble now. They kind of go, what the trends are. It's like back in school. Remember back in the days of school, when in high school, middle school, you kind of go with the popular kids. That's how investing is working now. They kind of go, oh, this is what all the cool kids are doing now. Let me go that way. Instead of actually going, wait a minute, let me study the market and what's actually going on, and then make my decisions from there. So sorry for the long breakdown, but hopefully that explains it. Fundamentals versus the other two. The other two are just gamblers. I think a lot of them are morons. I think some of the quant stuff are pretty cool. They're just looking at the numbers purely and based on historical data. But again, that's not really investing to me, right? Investing is actually providing real dollars to companies that provide real value to society. And that's what investing should be. And this is why we have a lot of issues politically in this world and in this country, and why there's such a big discrepancy that's happening.
You nailed it, sir. And I think we had our most glaring bit of evidence before Wednesday's FOMC press conference, when Polymarket made a market for whether or not our wonderful Fed chairman would actually come out of the words, what was the gambling phrase on that one? Good afternoon.
Yeah.
And apparently it was 98% gambling on that. And they said, if he doesn't say it, there's going to be bad things happening. He says good afternoon and bad things happens. So much for the theory of the gambler, sir. Well, let's go into the fundamentals and talk about the macro picture that goes with it, because I'm more in your camp. I'm going to admit my biases. When I'm in the markets, I'm in the miners, and I'm in transportation, subjects I know about. I don't invest in things I don't know about. I think that's a big mistake for people, especially like you say, the gamblers who are betting on crypto banks, cryptocurrencies, various instruments which have no intrinsic value, and now they're trying to create intrinsic value by redefining the word. Is there a danger that people's escape from fundamentals is going to blow up in the first half of 2025, as despite what the crazy broad said on Bloomberg, pardon my French if you're all listening out there, uh, there's a very good chance of a major correction, and this is not the beginning of a major bull market.
Absolutely not. It's not a bull market. If anything, first things first, I don't like when people say bull or bear, right? From a standpoint, oh, I'm a bull investor, I'm a bear investor. I'm just an investor. People should just be investors. It shouldn't be, okay, oh, it's a bear market or a bull or a bear market. It should be, okay, fundamentally, what's going on in the world? What's going on with the economy? How are consumers doing? What's the labor market numbers look like? What's inflation numbers look like? What are the policymakers doing? Is the consumer healthy? So there's a lot of that. So I hate when people say that. It's like, oh, I'm a bull and bear. Like, you know what? Excuse my French. Fuck that. Okay, let's move on from that. So back to where we're talking about the gambling. It's a huge issue. The problem what we have today is, there's a lot of factors involved, right? Social media has created very impulsive type of mindsets because of consumer habits, consumer welfare, right? Everyone is kind of 30 seconds at a time. People lack patience, and also people enjoy that rush, right? They like that dopamine that hits them with social media and with content. So I think that plays a lot of factors. But when it comes to investing, it's going to be a big problem. And the big way to see that is not only in how people are trading, right? The poly market, people betting on anything. You see these damn fart coins that are making, tons of money and with no damn reason at all. I've been a big skeptic of crypto because, again, until you can describe me what it actually what value provides to the world, then you're not going to win that argument. Now, don't get me wrong, I get where they're coming from, right? I get the system is broken in many ways, and I see the wealth discrepancy. I see the argument of why for crypto, but that just means we need better policymakers. We need voters to hold their policymakers more accountable, and we just need more responsibility. Unlike Powell, right? We'll get to Powell. Powell is a hot mess, but focusing on the gambling, my biggest worry I have is, Wall Street has always asked these type of folks, right? These, coke addicts who love this dopamine rush, who like to take gambles because, again, it's not their money. It's someone else's money. If it's their own money, they love getting these types of risk, and they just gamble away, and they just hope that they get this win and this type of rush. But now, because of retail investing, the access that people have, thanks to technology and the internet, now everyone has that same accessibility to do the same. So now everyone can be similar, and it's spreading like a disease. So hopefully that helps answer a little bit. I have a lot to talk about with that, but you're spot on. The gambling habits are now in the investment world, because if you ask 99% of people who are investing, quote unquote, in the markets, I guarantee you they can't answer some of the most basic questions about each investment they're making. They're reading a lot of content from folks that are the buy, get rich quick type of folks on social media. And meanwhile, those folks are actually broke if you actually look at their bottom line. These types of schemes out there. So I just have a lot of feelings for the retail investor. I feel that there's so many of these predators out there that are taking advantage of the retail investors. And that includes my peers in Wall Street, by the way. All you're fucking doing is repackaging the same crap and reselling it out there. And now, regulatory folks say they're trying to protect consumers. All they're doing is just allow them to do the same things, just, let them use different terms for them. So, like buy now, pay later. I've been a huge critic of buy now, pay later. To me, that's a gamble. I don't know if everyone's seen that. This Klarna, Affirm guys, I've challenged the CEOs to debates on Bloomberg. Haven't heard a response. But buy now, pay later is a huge problem that's coming up in the financial markets, like you say, in 2025, and all this implodes. Buy now, pay later is pretty much you can buy something for $200 and now, but then pay high interest and pay it over 12 months. That is really scary. If you can't afford something that's $150, $200, and you have to do a buy now, pay later after all your credit cards and everything, That is bad. And that shows you how bad the consumer really is. So the consumer resiliency, it's not there. It's that to me is real fake news right there. The consumer is not resilient. Their credit card delinquencies are increasing. Credit card debt's all-time high. Savings accounts are drying out. Buy now, pay later is becoming a huge industry. I think it hit 500 billion, and those companies are beating earnings. So that just shows you that the consumer is getting desperate. They are stretching their means and trying to do buy now, pay later as well. And so on top of that, the gambling problems and everything, it is going to get really ugly in 2025. And I've called it. I mean, our firm has called stagflation is going to hit. And a lot of these debt rollovers are going to get real ugly. So sorry for that long rant. Hopefully I didn't get out of line here. I just wanted to throw all that in there.
No, you're absolutely correct. Actually, the stagflationary theory is exactly what I believe, and we'll get into the discussion about the Fed and the wonderful job Jay Powell's doing.
Oh, Lord.
Just briefly, because both of us really don't want to. We want to eat dinner tonight. We don't want to lose our appetite. But the bigger issue I see with consumer credit, which is one of the subjects I wanted to touch on, a lot of people have been inspired by the Robinhoods and some of these other new online brokerages to become the FanDuels, the DraftKings, the Hard Rock Bets, the gambling sites, and view stock markets the same way. They don't seem to understand what's going on. And I think one of my bigger criticisms, and I'd like your take on this, no one has explained to me the purpose of zero DTE options. I think it's just a pure gambling play. It's no different than playing blackjack on the table. Look, I like to gamble. I'll admit it. But there's time and place for it, and investing is not that place. Is there a danger that we, because of the actions of Bernanke in the past, that the investor, the retail investor, believes that there's going to be a bailout for all of the people who lose at the big table?
Oh, there's a huge danger. Absolute huge danger. I don't fucking understand how all this is being allowed to the retail investor. I mean, as someone who leads a team of investors and we manage money, the amount of education you need, the licenses you need to be able to actually trade those types of things in the past, it requires a lot of knowledge and understanding of what you're doing. And to allow this to open up to everybody concerns me. Again, I'm not saying retail investors are not smart. They are. A lot of retail investors do their homework. The access to information is terrific. But at the same time, you need to have the proper education and experience to understand what these types of trades are, and to know what you're doing. And to bring up, the gambling problem is regulators and leaders of these financial institutions and these gambling companies and the Robinhoods of the world, they are just opening the floodgates because you have to understand how to make money, right? The Robinhoods and the trading platforms, they make money of how? They make cuts of everything. So the more volume that they get, the more money they make. So that's what retail investors have to understand. They're not looking out for you. They're not. They're just trying to lure you in to make as many trades as you can, regardless if you know anything or not, so they can make more money. So, and that's the same thing with all these folks with the gambling of the DraftKings and all these guys, which I hate them all, by the way. It's a free country. You can gamble if you want, but there has to be something in place to try to help people not fall into that addiction trade. And the fact that the stock market is deemed as gambling now really upsets me because A, sadly, it's true. But B, it shouldn't be that way. I mean, I miss the days of where, when you got in the stock market, it was something of prestige, right? It's like, wow, okay, I'm going to spend my time, do my homework, take pride in the investments I make, knowing that, wow, this is the best investment I can make because I know every little detail. I can name the management company. I can name the management of that company. I can tell you the P&Ls. I can tell you that they're developing this product the next 3 to 5 years that's going to change the game, all the sorts of things. That's pride, not just in going, oh, I'm just going to buy this company because I know it's good. I want to make these zero DTs trades just because I want to and I think it's the cool thing to do. Or I'm just going to, see this because some person on Bloomberg said that. That is what's scaring me. And I think, retail investors just need to be extra careful, do your homework. And if you don't know, then don't trade. Okay. Ask for someone else's advice, study more, or you're just not comfortable. Just stick to your fundamentals and investing in companies that you do like. And like I say to a lot of people, this is my final note on this. It's, oftentimes a lot of retail investors don't have enough time to do this homework, right? Everyone has a life. Everyone has a full-time job or multiple jobs, right? You look at the labor market, we'll get into that. Most people, a lot of people have two full-time jobs now or multiple part-time jobs, or, you have your own life you have to deal with. So there's not enough time, unless you're a full-time investor or a trader, you're not going to have that much knowledge or ability to make those right trades if you're just fully trading. That's why I always recommend, ETFs like the Vanguard S&P 500 or some of these other types of indexes, because in the long run, you'll win. But we try to do these trades, constantly every day. You're going to fall in a rabbit hole because you lose one day, but then you gain the next day. You get to that rush, it gets you in the rabbit hole, which is exactly what gambling is. And don't forget, the house always wins. And that's the problem.
Fantastic analogy. And let's move on, because we're seeing the gambling mentality to make up for the losses. And I believe a lot of the losses are in some of the personal investment decisions we're seeing with the citizenry, and it's killing the retail investor, even though the information is accessible. Like you said, most people don't even know what a 10K is, a 10Q. They don't care. All they look at are, well, it's up today, it's down tomorrow. I can buy this and go 5-1 and make a profit on it. They really don't look at the big picture. My concerns on this for you is, as we move forward, we've had a very easy policy since the 2008 crash, where everyone is allowing someone else to make up for the losses, and then the smaller guy gets crushed. They keep thinking there's going to be a bailout. The bailout mentality, though, has gone to housing, automobile ownership, credit cards, etc. Now I think that's going to permeate into equities and investments. We really have a major problem heading into next year, as all of these models that these people based their theories on and their gambling have never endured a recession and stagflation, a model of disaster when you have cyclical mini recessions through a long-term period. What do you think? I mean, I know what your opinion is on investing. Trust me, I get that. But what do you think is going to be the outcome as people realize during a period of cyclical stagflation, where you have 3-month recessions, 5-month recessions, and inflation and interest rates skyrocketing to levels unseen since the 1970s?
I think we are in some deep trouble, or I say we're in some serious shit coming up in the next couple of years. Okay. Again, sorry for my French, but I get very passionate about this because I hate seeing everyday people or just people in general get hurt by the policies put in place and by these predatory companies that are taking advantage of just the volume. And so what I see happening is this, right? You nailed it from a standpoint of auto delinquencies are going up, credit card delinquencies are going up, right? We mentioned earlier, buy now, pay later is expanding at a rapid pace. Credit card savings going down. And by the way, when people say consumers are resilient, that's bullshit, because that they're only looking at the luxury spend pretty much, right? And the luxury market is going to be fine because there's a huge wealth gap discrepancy that's growing every day, which should be a concern for policymakers, because the middle class is what drives this country, and they're hurting, right? I just saw today people that are making $50,000 or less are now skipping meals. That tells you a lot, right? I mean, they're skipping meals, they're skipping mortgage payments and all sorts of things. So what's going to happen is the government's debt is already at seriously high levels. You're entering a time in where you have a Biden administration that has ran our economy to the ground, in my opinion, or it's positioned itself to run itself to the ground. You have an incoming administration in President-elect Trump, and where we all, whether you like him or not, it's all about his reputation, right? Or any president. So they're going to try to drive the economy as great as possible. And my worry is, are the policymakers, Powell, the new Secretary of Treasury, Scott Bassett, Is Congress, well, Congress is not going to, but is the president willing to swallow their pride for a couple years to get our economy back in order? Because if stagflation hits, that is a rabbit hole that we cannot bounce back from unless some dramatic measures happen. And how does that handled? You have to spike interest rates. That's really the only way of doing it. And I think consumers are going to have to get hurt before it gets better. And, you know, I talk about this with my business partner, Willie Costa. He's our COO, and we talk about this all the time, and we have a piece coming out about it. And let me take a step back here. Powell and the Biden administration has really gotten us to this point, right? So what has happened is during the COVID crisis, I thought Powell did okay, but he has been a terrible Fed chair when it comes to the transition from post-COVID to now for recovery. Reason being is he has dragged out the recovery or try to recover for the past 6 years. Okay. He's tried to target inflation down to 2%, all those types of things. But the problem is this: he should have spiked interest rates at a much higher level quicker. Okay. Just like how Volcker did it. So when you have during COVID demand super dropping, and then supply still all-time highs, what happens, right? The prices go down, all that kind of stuff happens. So when we got out of COVID, when the world was recovering, demand spiked, but the supply wasn't able to keep up to it, right? So that was a problem. But now you're seeing supply getting caught up, or it got up, but then demand is starting to weak again. So it's dragged out for so long. And this is what we've been worried about, is instead of addressing the problem at that time by spiking interest rates, I was even saying 6 to 8%, to slow down that demand so the supply can catch up to ease inflation. He just dragged it on. He literally just dragged it on. And when you drag it on for so long, this is what you see today, right? You're seeing him taking a step back from inflation. It was supposed to be 2% by end of 2025. Now it's 2.5% now he's calling for. So inflation has lost control. He's losing control of inflation. The labor market is not responding to how he wants to respond. And what's going to happen is all these people that have these trades or all this debt they're going to hold, it's going to cost them. I see a lot of 2008 similarities, just not how it's led to this point. It's fiscal now. That's the problem. So in 2008, you have the big banks that were making these terrible bets that caused 2008, right? Government has some play into it. But now what we're seeing in 2025 is you're seeing government now causing this massive issue. Poor policy is going to lead us into an 2008 type of situation. And you're going to see people, they're going to file bankruptcy at all-time highs. You're going to see people on the streets. You're going to see people losing their jobs. You're going to see people upheaving. I mean, when you see this type of level of distrust from the markets to the Fed, and then from the people to the government, and then you combine that with a poor economy that's coming up, you're going to see a lot of political instability. It's going to be a scary moment in the next couple of years. And I'll be very fascinated to see how the Trump administration handles this, because they want to recover the economy, but are they willing to do the necessary things? Because we all know the Trump administration does not want to raise interest rates. They do not want to do the necessary things that, in my belief, that's going to stabilize the economy. So deregulation only goes so far, right? And if anything, we should regulate a little bit more in the retail investor side, because retail investors are going to drag in. So anyway, sorry for the long explanation there. Long story short is our answer is you're going to see consumers getting slapped in the face and being put on the streets is what's going to happen. And I don't know if the government can bail them out because of the spending that we have, but consumers need to be bailed out. There's just too much debt for each consumer. And when the check comes due, they're not going to be able to afford it. So it's going to get ugly.
Vin, I appreciate that. I'm going to take this quick commercial timeout. Folks, MacroEdge.net Ozone, MacroEdge.net Ozone. Get a free 2-week subscription. Go to MacroEdge.net. Also, check out the RE sites, our real estate research program. Go to MacroEdge.net today. Vin has hit some major home runs. He sounds like a copycat of me in some ways. Just kidding, Vin, because I've been of the argument that we've been in an 80-20 recession where 80% of the people have suffered since late last spring. And I don't think people understand what stagflation is. It's not a recession all at once. It's a cyclical event that occurs over many, many months, if not years. In the 1970s, we're just like that. Powell's hero is Paul Volcker. And for those of you that haven't heard Vince, this is the first time you and I have ever spoken to each other. I am a notorious Rudy Havenstein type Powell abuser, along with somebody who's been trying to expose all of the sins of Paul Volcker in the 70s that most people are not aware of. We just had a series of rate cuts, which are going to reignite inflation, in my opinion, and I'm sure probably yours also, to a level above 5% for quote-unquote CPIU, for whatever value that number has. Today we got a PCE reading. I think it was an anomaly, basically due to energy prices. I don't think energy is going to be the issue. I think consumables and service is going to really crank up the inflationary pressure on our society, along with a contracting employment picture, as a lot of companies can't afford to refinance into 2025, including basic operations. If we look at today, Party City and Big Lots, both gone, total liquidation. I think we're going to see an acceleration in those weak hands that don't have good cash flow, back to fundamentals, as you said, and also to companies that were built on speculation versus real sustainable long-time earnings. What is your take for the first half of 2025 on that theme?
Yeah. So what's going to happen is, the fun thing about both inflation and the job markets is all these media types and all these economists, they tend to spin the numbers to their narrative. And that's something that the listeners need to understand. That's where you got to look at the hard numbers yourself from the actual data source. All right. Don't listen to just them from their Twitter page or what they say on Bloomberg. A lot of them are full of shit. So if you look at it, job openings have steadily trended downward since Q1 of 2022. Okay. So job openings have been lower for several years now. And a lot of the job numbers you see is U3. Okay, that's what's reported, and U3 does not include people that have quit looking for jobs, and it also does not include people that have multiple full-time jobs. So that's where we look at U6. Okay, U6 has slowly trended downwards since Q2 2022. So more than ever, you see more people having 2 full-time jobs. That's saying a lot. And also the participation rate of people in the job market is at all-time lows. Okay. Meanwhile, you see wages going up and all that. And at the same time, you see inflation going up, people not being able to afford as much. So that combination is ugly. And then on top of that, because of the interest, the inflation going up and the interest rates going up, corporate debt, right? That's one thing people have to look at. Corporate debt rollover is going to hit in February. Okay, that's going to be very fascinating to keep an eye on because a lot of corporations have been taking a lot of debt, and they're going to have to cut jobs. And I think the labor market is going to continue to get worse. I could see it hitting 5% jobless next year, or even higher. I see the S&P correcting 10 to 20% when the first half of 2025, and inflation ticking back up towards the 3-4%. So that's my analysis there. It's just you're going to see a ton more job cuts for 2 reasons. AI, okay, artificial intelligence. You're seeing a lot of them putting more money into AI for efficiency. They're trying to replace a lot of these human jobs with AI and machine learning because it's more efficient. They don't have to pay them health benefits. They don't have to put an office for them, all those sorts of things. So that is a key factor in a lot of this with the job labor market. And then number two, they're just going to be able to afford it. I mean, the amount of interest payments, just like our government, right? Our government's paying a crap ton of money on interest payments. Corporations are too. And that's where the Fed has lost control. And I think they haven't factored a lot of that in my opinion. So you're going to see a lot more job cuts, and that's going to contribute to a lot of these people, sadly, being kicked to the curb. And you're going to see a lot of people hurting in the coming months because of inflation going up again. You're going to see job openings continue to get cut, people getting fired, and then on top of that, will this new administration cut benefits? That's another thing, right? Will they cut benefits? Will they get rid of support for people who need it? So there's just it's going to be a fascinating first half of 2025. And I think this week has been a good model. I mean, look, the CR. Will they pass the CR? And another big part of the, speaking of government, another big part of the job numbers is government jobs make a big part of it. So if the Trump administration and Doge come in, which I agree with a lot of what they're doing, they cut a lot of these jobs as it can contribute to the unemployment numbers going up. And and the fact that Republicans weren't able to pass a CR bill that was supported by the president-elect when they have an 8-seat majority with Trump support, it's scary for legislation in the next couple of years, which plays a huge factor in how the markets are going to respond and what happens with the labor market and inflation.
Well, I'm a firm believer, like yourself, in the bond market, because there's an expression: the bond market is smart money. The gamblers, they all trade in stocks and day trade to pray and win something happens big at the table. I've noticed one of your tactics is to short via the 10-year via ETFs. And I believe the same thing, because Scott Bessent's strategy is to reverse years of Janet Yellen's incompetence. I don't know if he can go all the way back to 2004 and erase everything she did as a Fed president and Fed chair, but the biggest issue is her as Treasury Secretary. She failed to take advantage of lower rates for long-term debt financing. Bessent is a pure believer that you stretch out the debt obligations, and he's probably going to focus on the 5, 10, and 30. And to be honest, I wouldn't be, in my personal opinion, I would not be surprised to see a 40 or a 50-year bond suddenly appear on the horizon. Do you think that strategy is going to have more validity next year? Yours truly, your host, has projected that we will see, and I agree with T. Rowe Price, by the end of next year, a 6% 10-year. How dangerous will that be for the economy and the markets, not planning for these kind of spikes, especially as they move in large increments in the first half of next year?
I don't disagree with you either. I mean, I can see it. I mean, look, back in September, when Powell and the Fed cut 50 basis points, we knew inflation was going to whipsaw again. We knew that was going to be a hot mess, and that's when we shorted the 10-year, and we predicted that it was going to hit 4.5 again within the next couple of months. And sure enough, this past week it hit 4.57. So we were proved accurate, and quite frankly, we made a good amount of money on that short, and continuing to hold that short because we do see next year that the 10-year can hit 5 easily, 5.6 easily. I mean, I wouldn't be surprised to hit 6.3, to be honest with you, 6.3 to 6.5, because you just can't ignore the numbers, the bottom line numbers with the debt and everything going on. So what happens if that gets to 6? It's going to be uglier than what I just said about the labor market and stagflation and all that. I think that they'll guarantee us into a recession / stagflation. You're going to see corporate bankruptcies spike. You're already seeing some of that, some of the small bankruptcies trickle up. So you're going to see corporate bankruptcies spike. You're going to see some municipalities default on a lot of their bonds and a lot of their payments. You're going to see credit card and other lending interest rate spike, and that's going to cause a trickle effect of people not be able to afford credit or loans. You're going to see the housing market tank because mortgage rates will will climb back up, and which, by the way, has been climbing back up in the past couple weeks or and longer. And that will guarantee a stagflation if it hits 6. And again, we're already predicting that in 2025 stagflation will hit more than likely by the middle of 2025, because I think it'll be inching towards 6 already halfway through. But my biggest fear is that if we don't make drastic changes on the policy level, we could end up like Greece, to be quite frank. And we just said that, I think, recently in one of our pieces, that we will end up like Greece if we don't get our shit together. To see a country like the United States hit that way, the global effect will be ugly. And another thing to look at too, another factor is you look at the other markets, right? China is in a bad place. I mean, China has trillions of hidden debt in the municipalities. Their economy is really soft. Their currency is struggling. And with the tariff things coming up, it's going to be interesting to see. So that's another X factor involved in this, because if they start to struggle even further, that's going to drag us down as well. And that's what I don't understand about these fucking analysts on Wall Street and these damn policymakers at the Fed and the Treasury and all that, is how they not see this, right? And that's what's concerned to us, and that's how we're positioning our portfolio, is to prepare for that. Is to prepare for this next 2 years to be real ugly. And I mentioned earlier about this new administration, and what I'm worried about is fundamentals, right? The fundamentals of how to handle these moments on correcting the economy. Will this Trump administration be willing to do those things? That's the biggest question. If they are, we'll suffer for maybe about a year, 12, 18 months, and we'll start getting back to normal. But if they don't, we are going to be in the 70s, okay? I see a merger of a 70s plus a dot-com crisis is what's going to happen if they don't do that, right? Because a lot of the AI stocks are inflated. I mean, the markets are trading 48, 50x, which is fucking insane. People lost their minds on that front. And then combined with, what we just discussed about for the past 40 minutes, it is going to be something that we've never seen, actually. So a lot of people like to compare of, what happened before in our country's history economically. But I don't think we're going to, we're not going to, this is going to be a totally different experience. Again, if they don't take control over the next year. And on top of that, one of the things I've said before is, the past, you look at S&P the past 30 years, let's say, right? It's gone up. The returns have been great. And we've rebounded and all that. But we had different type of leadership. We've had still fundamental investing. Technology and online was different. Access to information was different. The retail investing was not as significant. The next 30 years, I don't think you're going to get the same type of returns that we did in the past 30 years. And the reason being is because at this moment that we're speaking, and what has led up to today is going to result into the next 30 years not getting, it's still going to be good returns, don't get me wrong, but just don't expect the type of returns in S&P the past 30 years as we will in the future 30 years because of all this. And again, just to recap, if it hits 6% or higher, which I think it will, I agree with you. You're going to see stagflation plus a dot-com combination. You're going to see corporate bankruptcies. You're going to see municipalities tanking. You're going to see consumers on the streets not affording anything, filing for bankruptcy themselves. And you're going to see a banking crisis as well. You watch. That happens. You're going to see a banking crisis on top of that. Sorry for missing that. You're going to see a banking crisis. I mean, you saw a little preview of it, right? And it's going to get a lot worse. And if anything, the only bank stock that I would trust it would be JP Morgan because they're going to eat them all up. Outside of that, man, it's going to get ugly. So that's the summary there. It's just, if that hits 6%, it's going to be one of the ugliest things you'll see in history. Now, don't get me wrong, I think we'll come back. I always believe in America. American resilience will always be something I believe in. But I just hope this may be the moment in where we finally get bitch slapped hard enough and where we get our act together. Because clearly in 08, we didn't, learn enough, because we know what happened in 08. Nothing really happened. Quantitative easing gave us unrealistic expectations. Bernanke and all of them didn't stop it when it should have been stopped after a certain amount of years. And we're living in unrealistic expectations, and we just amplified it over the past year or two. But now it's time to correct it, but we may just need to hit truly rock bottom to actually finally correct it, just like what you see in Argentina and what Greece had to do. So hopefully, I don't want to sound like a doomsday person, but I just deal in reality, and I look at numbers, just straight up numbers, what they look like and what policy is looking like, and that's what we're seeing.
You're going to put me out of a job. I'm supposed to be the doomiest person on the internet as one of the few bears remaining. To be quite honest, this brings me to, I have my skeptical view of Donald Trump only because of ethical and personality issues, but I have a lot of hope that he does the right thing. And there's a lot of hope that he does become a Harding-Coolidge model and lets the pain hit next year. I would accept a deep recession in 2025. My concern is, and this is the question I'm leading up to before I get to our two big final questions for you, sir, and I appreciate all your time today. Do you envision, as a fear that I'm fearful, that he might take a Hooverian path and go after the employment revisions in February and the inflation revisions, which we know we're going to get, and they're going to be horrible, and potentially the NBER finally getting off their ass and saying, okay, the election's over, we had a recession last year, blah, blah, blah. Do you expect him to push for excessive fiscal stimulation in concert with the Fed's whatever the hell policy we want to call this right now?
Yes, sadly I do. You have to understand the man of who President Trump is. Look, I mean, I support a lot of his policies. He was a way better option, in my opinion, just personal opinion. I'm not trying to bring this in politics here. In my personal opinion, I think him and his team are way better fitted than the Harris campaign. Again, we just had terrible choices, guys. We had terrible choices in this last election, bottom line. Okay. And I think he will. I think he's someone of ego, right? He wants to make sure he looks like the good guy, and he made major promises in the election to bring back and make America great again, and to make the economy great again, and to make things more affordable and more jobs and everything like that. So my fear is he's going to do that, and a big indicator was just yesterday when he came out saying that we should get rid of the debt ceiling. Okay. Now, look, we can argue that the debt ceiling is artificial and that they still pass the bills and all this kind of stuff, but at least gives us something to at least address that we got to spend less than what we promise. And at the very least, from a legislative level, it makes our lawmakers think twice or multiple times about raising that debt ceiling. So, I mean, that's just how our legislative process works, right? Is you have to have Congress work together to actually pass something. But for him to say that already shows me that he does not give a shit about those bottom line numbers. He just wants to see a major stimulus injection so that the economy the S&P jumps up, and businesses do well and continue to artificially boost the economy. And sadly, that's what I see. I don't think he's someone that's going to be willing to do what's necessary, like what Reagan and Volcker did, right? The big difference back then was Reagan knew what had to happen, and Volcker knew what had to happen, and Reagan had Volcker's back. That's the key thing, right? Is a president having their Fed chairs back. So right now you have Chairman Powell have 2 more years left of his tenure. You already know Trump is not, he's letting him keep his job, but will he? We don't know. And we already know he's not going to support him. So you have uncertainty from Powell. You have uncertainty from Congress. You have Trump, who changes his mind every damn second. But again, he's going to drive stimulus, in my opinion. And as someone who has eyes and ears in D.C., there's already a lot of talk about that. So But his thinking is because they're cutting spending, they can afford it. I just don't see that, in my honest opinion.
I understand. And by the way, you just really threw a scare into the entire MacroEdge team, because they're like, please don't get John on the Paul Volcker soapbox, because most people do not know that Paul Volcker was the one who talked Nixon into getting off the gold standard. And most people don't remember that Paul Volcker did 3 rate cuts from May to July of 1980 that caused a super spike in inflation into 81, because he was scared of what a Reagan cowboy administration would bring in. It's insane. But we're repeating history once again. It's a recycling in a different form, in a different format. It's scary as hell, to be honest, Vin. And that brings us to the issues for the Fed, because you and I can beat the hell out of Jay Powell all day long, and that dog's just going to lay on the side of the road. There's 3 issues that I see right now for the Fed. It's going to be a challenge and will directly impact fundamental investing, because the speculators are going to get murdered next year, in my opinion. And that is, with the monetary policy, is it going to be more important to stimulate credit access to the 80% enduring the hard times, or making sure employment remains stabilized just to sustain consumer activity? Because there's a paradox here. If you stimulate credit access, the rate and levels of defaults increase dramatically. At the same time, as you said, we're going to have a banking disaster between housing, CRE, and consumer defaults. Some point, you just have to say no, put your foot down, and let it implode. What do you think the biggest danger is?
A lack of leadership. I mean, the lack of leadership and brass balls have really failed us over the past decade, really, especially the past couple of years. People forget, someone like a Chairman Powell, they are supposed to be, not politicalized, right? And the problem is they've been falling victim into politics. Politics is the disease that has caused all of this, and the pressures. So the lack of leadership to me is number one. But to the actual point, if I was making the decisions as president, what I would do is, or the head of the Fed, right, is I would actually take a step up. I would literally have a speech saying politics have nothing to do with this. I will not fall victim to any political bitching that is going on the Hill. My job, you put me as the Fed chair to make sure I keep the economy stable, partner with my friends at the Treasury, and I will put out a legitimate plan that will stabilize the economy over the next 5 years. There needs to be like a 5-year plan that can ease the markets with a clear, concrete agenda and a strategy to get us out of this with the minimum amount of damage to both the consumers as well as institutions. And that's been the problem. There's been no clear path that has laid forth by Powell and the Fed, right? I mean, they took a step back. They were talking about bringing down inflation to 2%, and then all of a sudden they switched to the job market, and then they say the target was 2%, but now it's 2.5%. It's this whole, the whole inflation is transitory claim. It's been so many mixed messages, and this is why the stock market's going out of hand, because they don't believe whatever the fuck Powell says, right? And the people don't understand what the hell's going on either. Meanwhile, they're going to grocery stores and they're paying out their ass on everything. And then you have the banks that are kind of afraid, and they're being not sure on what's going on either. But regardless of that, the only way to solve this is 2 ways. One, you got to put the brakes on it. All right, it's time. But you have to address it in a way where, look, we're going to do it now. It's going to be better to suffer it's going to suck. We're going to have to suffer like hell for 12 to 18 months rather than dragging this on and Armageddon happens in the next couple of years. Or you put together that plan. It's like, hey, I have a 5-year plan. You can name it something fancy. And this plan, it's gonna ease inflation while taking better control of the job market and ease the pain on the consumers and institutions. I think Willie and I can write something out like that, which we're happy to present. Hopefully Willie's listening, and hopefully he doesn't kill me for saying that. But I know we've been talking about presenting a plan publicly that we think can work well to stabilize this. But as of now, with the options of what they have, it's put the brakes on it. It sucks. People are going to be hurting. Banks are going to be suffering. But sometimes you need that reality check. I think I hinted at just a few moments ago. It's the only way investors will learn, institutions will learn, government will learn, is to get slapped hard, to hit rock bottom. It's something that one of my friends who's a really good men's mental health therapist told me once, is that sometimes you got to let someone hit rock bottom before they can actually build themselves back up. And I think this country and this economy is at that moment in where we have to have that. Because if you keep bailing out, if you keep trying to do the stuff like we did in 2008 and then back in .com and all that, all it does is delay the ultimate result, which is you have to learn the lesson. So if we don't put the brakes on it, it's just going to drag on and it's going to hurt more. So, whoever's listening, it sucks. And I hope that you're able to have enough savings and you can endure all this. But the Fed just needs to put the brakes on it. And we need to hit rock bottom before we can climb back up. And the lessons are learned. Because once that happens, all of a sudden you see investors going, okay, all right, well, we need to fix this. We need to fix that. Institutions will start to be more responsible with how they lend or how they, do their products or sell their products. You start seeing retail investors going, okay, shit, all right, I got to do more of my homework, or this is actually how investing works. You're seeing policymakers, going, okay, all right, well, we can't have this happen again. So no, we may need to have a grease moment before we actually learn, because I hate repeating it, but I like saying it multiple times so people understand this. It's, we just have to have that moment where we fucking crash into that wall, learn from it, study it, and then the path forward can be, all right, this is how we move forward because we learned our lessons, and we'll be better. That's the only way we can do that.
We 100% agree, Vin. Besides, Jim Grant wrote a great book about the Forgotten Depression. Everyone needs to read that book.
Agreed.
The 2021 solution would be our most optimal outcome, as painful as it would be, except this time we could provide a safety net for the very poorest in our society versus that era. Our own Six has a question before I get to the big question. You don't mind going over a few minutes, do you? You don't have another obligation. So I'll give you a few minutes, sir.
I have set 2 hours for you.
Oh, my goodness. Six? Bring your questions, and please don't use the whole hour up.
Hey, Vin, how you doing? So in terms of like having, the markets and the economy take its medicine, I've been thinking about this a lot, and we know what kind of guy Trump is, right? He's very egotistical. He ties his value to as a person, as a man, as like his whole brand to, the economy itself. So, I mean, what kind of chance do you think that he would let that happen? Because I don't think that there's a chance in hell that at the first bump in the road, not even a major downturn, that he's going to be turning on the fiscal helicopter money. I mean, that's my opinion.
No, I totally agree with you. I mean, depending on what we see, look, we're predicting Q1, there's going to be at least a 10% correction in the S&P. And, you're going to see some of the key indicators we mentioned that we should be worried about in 2025 start kicking in. He's going to immediately do that. You look at his first term, look what happened, right? As soon as anything turns a little bit against what his agenda is, he makes rash decisions. He'll fire someone, he'll force something, he'll sign executive orders. So no, I definitely see that. He's gonna do whatever it takes because it's his last term. Right. And he's going to want to leave a legacy that is the greatest economy ever. And he's not going to let anything or anyone get in the way of that, which is why I would never want the job of Secretary of Treasury, Fed Chair, or Head of Economic Council under him. Does that help?
Yeah. So then I'm guessing. Yeah, it does. I'm guessing then that you're anticipating the curve to drastically steepen.
Yes. No. It's going to steepen. I think it's going to steepen, and even if they try to do the 40, 50 year, that's just going to be a hot mess. That's just going to make everything worse. It's going to actually what's going to happen. It's going to make investors lose more faith in the Fed and in the U.S. Treasuries and the future of the U.S. I mean, that's what people to remember. These bonds and these treasuries, they are literally what the indicator of people's faith in our country. And I think if you do 40, 50 years, you're going to start losing people, major players as well.
Yeah, I would agree with you there. Another question. What do you see as the source of the inflation rebound, if anything? Do you see it as more fiscal policy or as a carry through of rate cuts, a China rebound? What are you looking at?
I think it's fiscal, mostly fiscal, because the problem is, when you have the quote unquote consumer resiliency, which is funded by debt and credit, the only way you stop that is if you hike rates so that people can get checked, because you have all this spending that's going on, which doesn't make sense because inflation's going up, and they're continuing to increase their debt obligations, which increases demand while supply is trying to catch up. There has to be something that offsets it, and that's Fed policy. So if you spike interest rates, that should subdue demands so that things can kind of get back in order, so that prices can go down. So to me, that's the only way you can do that, in my opinion. Feel free to disagree, but to me, that's just fundamentals again. And this is something that's been going on for a century or so, how to manage this. And it's just amazing to me how sometimes the basics of managing inflation gets lost. Right? To me, 2 + 2 is 4. For these guys, for some reason, 2 + 2 is 8, which makes no sense to me. Does that help with that?
Yeah.
Hopefully that helps with that.
Oh,
yeah. I mean, it's just sad to see, Six. I mean, it's just I just don't get it. If you see consumer resiliency, that's actually not a good thing in this current moment. You should see them spending less, if anything, so that we can get things back in order. Yeah.
Here's another question I got for you. I put on yesterday, throughout the week, the 2 year, 3 month basically flattened, and I started to put on what I was hoping to eventually become a very large 2 year note futures position. Took a pretty big bite out of it already, but if what you're saying is true, do you expect the curve to start pricing in hikes again, or are you more just looking at duration on that?
So what I see with that is I see two things. I see the curve going back up, but also I see the possible hikes going to happen next year. I mean, one of our peers is Apollo Global Management, which you guys know is a major financial institution. And they see, and they're usually pretty reserved in their forecasts and all that, but even they came out practically agreeing with our analysis, and they even said that they can see rate hikes next year, actually, because they see inflation just like us getting out of hand again, and the stickiness matters. So the longer inflation stays elevated, the more difficult it will be to bring down, and which means 10-year yields will go at 6% or 7%. Increase in gold prices is an indicator. So again, the indicators we see is that there's probably going to be maybe a hike next year, because the only way you can finally address it is to hike it. And number two, we see that curve, steepening. So it's. Sorry, I'm a little dragging here. It's just I hate seeing this happen.
Six, let me jump in real quick, Six. I got a question for Vin. Vin, do you think we're going to return to the traditional role of the bond vigilantes, and those of us who are more pragmatic pragmatic macro analysts where the bond market led the Fed instead of vice versa. Because I really think that long-term rates are going to blow way out of proportion. And like you said, especially if they start trying to put Band-Aids on with longer-term bonds.
Yes. You're going to see the bond market dictating, as well as you see for the equity side. It's going to be a stock pickers market next year. This whole thing's about trends and indexes and all that is I think it's going to be over. It's going to be the stock pickers market, and the bonds are going to start dictating what the Fed does. I mean, it's going to have to. Reality is settling in, and I think the Fed, at least a couple of the Fed governors, especially the one who wrote the dissent, I think sees that. He sees the fact that whatever they do, the bond market is reacting differently. Shows them that I think they lost control and they need to get control again.
Go ahead, Six. Oh, he must be out of range. Real quick, MacroEdge.net, MacroEdge.net, Ozone. Sign up for your 2-week trial. Folks, if you have a question, please pipe up, request to speak with our great guest, Vince, giving us a generous amount of time. This is a fantastic interview because it provides a bigger picture. And boy, did he start to touch on the big question I have for him, because I tend to believe a lot of what he says about a stock picker's market. And if you don't read your history about the 70s, a very, very hard lesson is about to occur. Six, go ahead, sir.
All right. So, I mean, stock pickers market, I love to hear that. It's been a while since we've seen one of those, right?
Yep.
Well, we've touched on macro. Do you have any micro things you're looking at right now that really excite you?
So from a micro level, I mean, look, the way we're investing right now is we just simply look at, okay, look, regardless of what happens with stagflation and all that, what is going to be invested no matter what, right? What are companies and what companies investing need, and what do consumers need? So, one of our biggest focuses on is going to be energy, especially for the data center demand with AI, because I think the pressures of costs are going to force companies to even invest more into AI. Now, when I say AI, I think actual functional AI here. So that's why you start seeing Palantir getting more popular, and Microsoft, these guys who are applying AI getting more popular, because these guys are looking for real solutions. So you're going to see a lot more investments into those guys. And then you're going to start seeing a lot more defense and space companies doing well. And then consumer goods from a standpoint of which companies are providing the best value, right? Costco and Walmart. And by the way, speaking of Walmart, their recession indicator is at the highest level since the pandemic and equal to just before 2008 crash level, by the way. So that's something you guys can look up if you guys don't know. The Walmart recession indicator is not looking good. In addition to the New York Fed's prediction model, the estimated recession probability is actually higher than what it was in 01, 08, and 20. So I know you asked about micro, but I just want to throw those couple things in there. But from the micro level, I haven't really thought much about it, to be frank. I think Willie has, my business partner, about what's going to happen, just because, we've just been so inundated with everything else. But I think what's going to happen in general is I think people are going to, businesses and consumers going to spend less, but they're going to look at more value when they go shopping, right? Consumers, they're going to look at more buying in bulk. They're going to be careful what they spend. I think grocery store brands instead of mainstream brands are going to do really well because those 20, 30 cents differences are going to be a major impact on their bottom line. And I think they're going to spend less on bigger purchases. So cars, housing, and all that. Housing is going to be a hot mess because I think especially new home buyers or younger buyers are going to delay it further because they can't afford it. And then from a business company standpoint, they're going to spend more in AI because they have to get more things more efficient. They're going to continue to invest in in innovation so they can do that, and they're going to cut jobs. I think a lot of them are talking about bringing 5-day work days back. I'm not sure they will, because of the way the economy is going. They're going to look at the cost of it. Where else? I think that's where we're looking at. I mean, they're when it comes to the equities, it's just everything is just so overvalued, and it's hard to really make the right pick right now, because everything is so expensive. So we're not making that many moves because of that. But if we do make moves, it'll be into companies that are going to help companies be more efficient and effective, like AI, and the supply chain around that, which is energy. So we're looking at, companies like nuclear companies, natural gas companies, because again, they could be very much deregulated, very much so. And then we're going to look at companies that are companies, for example, that have been around for a while, that are going to benefit from an AI turnaround. So for example, C.H. Robinson, right? They are a major logistics company. Logistics overall are going to take a little bit of a hit because of recession and stagflation. But they're a company that has a new CEO that came in. He held high positions at Amazon Logistics and FedEx and all those companies. And he's coming in and taking an old behemoth, and he is turning them around to be a more modern, efficient logistics company. And they're putting a lot of money into AI, and you're already starting to see the effects of it kick in. So those are type of companies to look at as well. So those legacy companies that are going to benefit from this new AI movement. And also they have a big moat. So they're not just freight. They do air, they do software, they do a whole wide range of things. So those are the types of companies you want to look at. So that's pretty much all that really stands out to us, to be frank. Anything else, overvalued, expensive, and bloated.
Yeah, I have that same problem. Every time a big chunk of the money that I manage has your plain vanilla long only mandate, and it's like every time I go shopping, it's like, God damn it, these prices. Oh
no,
man.
it is. It's insane. And again, unless they're a company that that's going to benefit from this AI wave, which is creating companies more efficient, or they're part of the supply chain, just like energy and all that, is really not worth it right now until you see a correction. So a lot of we're similar. A big part of our portfolio, we are there are staples, there are buy and holds, but the companies that we do invest in are going to be the ones that are up and coming, that we know are going to do well. For example, Rocket Lab is one of our favorites. We bought Rocket Lab at $3, and then we bought again at $6, and now they're at $23, $24. But the reason why we bought into them is because we know, Willie is an aerospace engineer, so he knows everything about them. But they're addressing markets that are up and coming, and they're going to be huge demand, not only because of where the world's headed, but also, the Trump administration, including the Biden administration, has been, but the Trump administration has been more so very friendly towards space and defense spending. Rocket Lab is, they're creating. They're addressing the middle market of commercial space. They're addressing defense areas as well. Their numbers look great, and their future is, they're really the only main competitor to SpaceX. So they're doing really well. We like Palantir because we see Palantir has become like the Oracle of AI. But they're one of the first companies in AI that are actually creating real solutions that are being applied, not from the chip making standpoint. Everyone's looking at chip making. We look at actual applications. They're applying it in healthcare. They're doing it in defense space. They're doing it in retail. So they're actually applying it. Now, many can argue they're overvalued, but you got to look at it from a standpoint. Okay, yeah, they're overvalued, but what growth do they have moving forward? I see them in 5 years being a massive behemoth in the AI space. So for our investment strategy right now, we will take a portion of our portfolio and invest in companies like that because we see huge potential in them, because they're going to be the ones left standing in 5-10 years, in addition to our staples, right? Costco, Walmart, they're going nowhere. And those sorts of companies. We love, Republic Services because, you need trash and recycling. That's going nowhere. If there's no trash and recycling, it's going to be a dirty, hot mess around the world. And so that's how we look at it. So for investors listening, that's the homework I mentioned before. It's the ability to do that kind of research and homework and understanding that despite what happens in the economy, which companies would be left standing after that mess? And are you willing to ride it out? Because regardless of how good a company or stock is, they're going to be hit hard by a bad downturn. But are you willing to ride with them to the end and through the mess? Because those are where the winners are created. The winners are created the ones that have patience and conviction of their portfolio. And so, I mean, we always stick to our staples, but you gotta be willing to make investments in those types of companies that you think in your gut and in your research, they are going to thrive at the very end. I mean, look, Palantir, we bought at 16 and again at 22. They're now at over 70. We think they'll go way over that, over 100 here down the road. We see Palantir crossing, Rocket Lab passing that. Vanova, we bought at 100. Now they're at 300 plus. Again, research, conviction, and those three companies are just an example of the companies we have that we know they're going to thrive regardless of what the economy is going to do well. They may go down 10, 20%. Fine. We'll live with it. But we know it'll go back up 40, 50%. So that covers the losses. It's very much how, one of our favorite people, Warren Buffett, invests, right? It's conviction, patience, and all that. And Stanley Druckenmiller, another person that we love, is just understanding what these companies are going to do.
It's funny so Stanley Druckenmiller, I put him right up in the realm with Jesus Christ, just a little under.
Yeah, we love him.
Yeah, oh man, he's the best. How could you not like him? And he's humble too. What a guy. But
yes.
But he's been on stage with Carp for years, and the whole time I was like, what the hell does he see in this company? I don't see it. Yep. And of course, look at that. He's right again. What a shocker. Yeah.
Now we saw Palantir even before Stanley was appearing with him, and that's one of the things that Will and I were looking at. It's whenever you see a fad happening, right? Oh, everyone's into AI, everyone's into this. You got to go, okay, there's definitely something there, but let's break it down, right? What will actually companies need from that, and what will consumers benefit from? And that's again why we love Palantir. It's because you have all these chip makers. You have ChatGPT, okay, you have these crazy apps that can do these. Okay, that's fine. But where is the real money going to be made? And that's where Palantir were smart. They actually spent all these years developing their own software, AI software, and focused on the key industries that are going to make a lot of money, and defense is one of them. I mean, defense is one of the biggest spaces that's going to see a major transition because of technology, right? You're competing now. The U.S. is competing now with China, India, Russia, and these other up-and-coming countries who are spending a lot of money on technological advances. Some of these countries didn't even start off with what we had, right? They're starting off fresh. So they're going straight to the cyber, straight to the AI, drones, and all that. So you got to look at companies that are going to do really well in that defense transition of the new modern warfare. And then you got to look at the supply chain of that, right? What's the supply chain of creating that AI software, as well as those defense equipment or weapons or whatnot? And that's what people have to look at, is the unspoken supply chain winners. That's where you make your buck. And that's what we believe in, right? Who in the supply chain is going to do really well for these big companies? And to the most successful investors, if you look at their portfolio, if a retail investor knows your portfolio, you aren't doing that well. But if they don't know half or more, you're doing well, because that means you saw something in the market that no one else sees.
There
That's
we go.
A really good.
I'm sorry. Go ahead.
Doc. All right. I got one thing. Vin, I've been seeing more and more of Elon and Vivek talking about, and just recently they're I don't know exactly what they did. They're canceling part of the F-35 contract with Lockheed, and Elon and Vivek are talking about more and more about drones. I want to like drones, but I can't really find anything that's appealing in the drone space just yet. But there's obviously the fact that, if drones become popular, you're gonna have Lockheed, Raytheon, GD start making them. But like, do you like any of the smaller ones? Any of them pure non-frost?
Yeah. I mean, look, this drone stuff, kind of, those types of things, I'm not really a big fan of from an investment standpoint, right? Defense is such a interesting investment because they rely so much on government contracts, and that's always jittery. And it's flat mostly if you look at the historical financials of these major companies. And this is why I look at more of like, okay, the supply chain product, right? So who's going to benefit? Palantir is creating the software for the drones, right? The building of the actual drones, okay, there's some flattery there, but how much can you really make? How many drones can you actually make? And how much is actually needed? So, it's a demand thing. So playing defense stocks is more of like, okay, do you see a big war coming, right? Like that's the kind of thing. What you got to look at is, okay, where's the money made on the development of these drones and the development of that? So you got to look at companies like Palantir, who are developing the software. You can look at companies like L3 Harris. So L3 Harris is an interesting one because they're the key company that creates the communications for the drones as well as for the troops on the ground communications. When the Ukraine war happened, we liked L3 Harris because you need them because the U.S. needed to supply them with these communications for the troops on the ground for the Ukraine front to help counter the Russia front. So that's where we look at it. But when it comes to actually creating and assembling, those are hard, right? That's why we don't like car manufacturers. We don't like, because the financials of that are never really that good anymore. So that's where we like to look at, the software side and everything. And then unless we see some geopolitically, unless we see a big war coming, then we'll put more money into those defense companies. But in general, they're more just dividend plays, those big defense stocks. Hopefully that helps.
Yeah, love it. Love the way that you think about things. John, you got it.
Thanks, and thank you for participation. And Vin, thank you so much for answering those questions. Going along that theme, I'm not big on the defense side of things because, like you said, it fluctuates with peace. And I'm hoping that we get several years of peace to follow up after all the turmoil the last several years. My theme is AI plus robotics. Those companies that are able to merge the two in an efficient manner that's presentable not just to the consumer, which is a low end side of it, but to the intermediate producer and into things like agriculture, which we're seeing agro-robotics beginning to take off. I believe that if we find the companies that merge those two themes together in an efficient manner, those are the ones that are going to set the future, not the traditional old chip companies, et cetera, like you were talking about.
Exactly. That's exactly where I got to look at is who's making those parts. This is the reason why we love GE Vernova, right? GE Vernova is a great company when they broke out the GE because they were creating. So people talk about energy. Okay, great. But what do you need? You need the pieces to make it happen. GE Vernova makes the pieces that's necessary for these wind energy, even the fracking energy, fracking process, and even nuclear, right? And the grids. You need their technology to actually, and the parts to actually make these things happen. So that's why they're a great company to pick. So when it comes to robotics, I agree. You have to find these companies that are going to do really well when it comes to robotics. So, I know one of the companies that we've been keeping an eye on is, and, you talk about defense. If they go public, there'll be a company that will definitely buy in, which is Enduro. Enduro is a fantastic company when it comes to their technology and innovation. They're actually creating the parts and as well as partnering with Palantir and the software to make it happen. But if they go public, great. Vecna Robotics is pretty good. The key ones to look at is the Japanese markets too. We love companies in Japan when it comes to robotics, as well as companies with modes. Itochu is one of our big holdings. If you look at Itochu, right, I know Warren Buffett likes these guys, but we actually came in before Buffett did. Is you look at Itochu, they have a massive moat, right? They have energy, they have mining, they have retail, they have manufacturing, but they also have robotics. So you have to look at companies with a big moat that also are investing in this space and are creating it, not just the new ones. So when you do your research, look at companies that are already investing in that space, but they're doing it themselves, as well as companies that are possibly going to IPO, because there is talk about a hot IPO M&A market next year. I'm not convinced yet, but if anything, if there are IPOs or M&As happening, it would be in the robotics space. And again, if you look at robotics, who usually tend to be the best ones that make them, it's Japan. So keep an eye on the Japanese market and the companies over there that are creating robotics. They're going to be the ones that I think are going to do a terrific job in it.
Fantastic. And I'm going to bring another one of our listeners. Tillberry wants to ask a question. Please go ahead, sir. Bring it on.
Yeah. Good afternoon, everyone. I'm from Canada, and I have some few questions that I've not been able to get some concrete answers on. It looks like the innovation, quite a number of innovations going forward, is to eliminate the human factor in terms of reducing cost and finding cheap inputs into productivity. I'm just wondering, sending back migrants to their home country, the Dodge, increasing efficiency within the government. I'm just wondering, and AI. So my question is, when you remove the human factor in all of this, how do you fund the social security? Who pays for the mortgages? Like, when Doge comes to effect, what happens to the mortgage in Washington, where most of the civil servants live? I'm just wondering, is this something that they're considering? Contribution to social security, and it could actually, I think it could lead to market crash. Sorry,
Yeah.
housing crash, particularly in Washington, where a lot of those federal workers live.
Yeah. And that's a great point, because I mean the federal workers, right, are a major part of the employment numbers, which is why it's so skewed in our opinion, right? The private sector doesn't represent as much as the federal. But to your point, Doge, I don't think they're thinking that, to be quite frank. I think their priority is just to cut. And that's part of the concern. Is I like what they're doing, which is cutting, but I hope they're being thoughtful about it. So it's a partial answer there. I have to do more research on that and ask folks in DC what they're planning on, how to cover that. But when it comes to Social Security, I know the current administration has floated the idea, as well as I have spoken to the Trump team, recommended that there's a sovereign wealth fund created for the United States. I think that's a great way of addressing Social Security. Now, will they do it? I'm not sure. How government works. Good ideas die at government, but desperation may cause them to do it. But imagine if they turn Social Security, right, into some sort of a wealth fund, right, and where they create a very dynamic team that are low risk, good return type of team, like a Vanguard, right, and they invest that money. We would be in a much better position today. But then the problem is the government leverages Social Security. That's a big problem. So regardless you turn to wealth fund or whatnot, at the end of the day, it's just the government needing to control their spending. How they do that, I think Warren Buffett's famous thing is that they will lose their job. They can't be reelected if the debt's more than 3% of GDP, right? I think that's what he said. But no, I can't give quite a concrete answer to that. I do think that it will cause a market ripple effect. But I think the only ideas that I think will work well to address that is to turn Social Security or create a sovereign wealth fund, and where Social Security is better invested. And then with the AI taking jobs with efficiency, I think what will happen is, like any innovation you see in the past, right? I mean, you've seen this in the past. I mean, people always worry about where the jobs will go. New jobs will come about from a AI innovation. So there's jobs within AI that needs to happen, and also you're going to see a shift more towards blue collar jobs. I mean, this is one of the biggest advice I give to young people. I'm like, don't don't look down on blue collar jobs. I mean, electricians, plumbers, sewage folks. I mean, all of these jobs are actually freight jobs, right? Truck drivers. There is a huge, massive shortage in those jobs. I mean, I think it's like $1 trillion worth of shortage in general. So there's a huge demand there. So if anything, yes, if AI takes a lot of these jobs, people just swallow their pride and move towards blue collar. There's nothing wrong with that. So I think that's where the big shift is going to happen. Is you're going to see these blue collar jobs going to start getting filled. And again, there's more and more demand. I mean, one of the biggest jobs that's creating millionaires are plumbers and electricians. And, especially with a younger generation coming up, not knowing how to do it, right? There's going to be a big opportunity there for a lot of folks. So hopefully that helps answer that question. I think it's a partially answered question. I have to do more research on one of the other parts of it, but hopefully that helps a little bit on that.
Fantastic. Thank you for answering it, Vin. Real quick, MacroEdge.net, Ozone, MacroEdge.net, Ozone. Check it out. Get a 2-week free trial and check out the real estate insights at RE Sites. Here's the bigger question for you, Vin. And this all ties into the government because Doge has to prove it to me. I'm one of those guys from logistics. You either show me how it works or I'll analyze it and tell you where it's screwed in the head. My biggest issue for the government right now is to fix the data problem. We have a data integrity problem.
Lord. Yeah.
And I was going to get your take on that. Which becomes first, fixing regulatory or the data integrity issue? I think the data integrity issue should be the number one priority. And that's going to mean cleaning out not just the people, but the mindset, because the data collection processes were designed, and I know people don't want to hear this, in the 70s and 80s.
Yeah. No, I don't disagree with you, but my thing is, why can't you do both? Right, especially at this moment, because I think there's enough data as it is in general to show that we are heading towards a train wreck. So get your fucking policies in order, but at the same time, there needs to be a complete audit and an overhaul of the data. I couldn't agree more with you. But in this time and moment, there's opportunity to do both. And if the Trump administration is serious and Doge is serious about creating government efficiency and cutting costs, this is the time to do it. They need to, if anything, if I was President Trump, I will let Powell take the heat. I'll be like, okay, look, just let the market, just let the economy crash because it needs to. Let Powell do his thing and put the blame on him. And meantime, Doge, cut costs, push this efficiency, audit the data, utilize AI to, to make it more efficient, get the private sector in there to make these changes. And then we can come out of it. But I don't see why you can't do both at once. But I totally agree with you. I mean, the data, there's no excuse for the current data mess that they have, especially in the days now that you have Bloomberg terminals and you have AI efficiency and all that. So I totally agree. One of our great investments that we have is a company called Arbo AI. And, they're a company where they're bringing real value, as in, they're helping companies and governments to actually go in and audit the technology and the actual operations of where they want to apply AI. I think the government needs to use a company like that, or any company, to actually go in and do it. And it shouldn't take that long, to be quite frank. It should be 1 year max, if you're willing to get bureaucracy out of it. That is the key thing. So to answer your question, do both.
I totally get that, and I wish that our great bureaucracy would move like that. It's going to take a very aggressive move by the Trump regime to do that.
But Doge is the one that can do it, right? They talk this big game during the campaign, right? Fucking do it then.
Amen, brother. Amen. I'm going to bring up Puzzled Raccoon, one of our listeners. He has a question for you, and then we're going to start moving forward because the big question is coming, and I bet Vin has a couple of things to say about that. Go ahead, Puzzled.
Hello, guys. I always love the MacroEdge team here and the insights that you all bring. 100%. I did want to kind of circle back a little bit with a question about the AI, because we're all seeing the hype, that AI is going to replace a lot of jobs and that sort of thing. But it's not hitting home with me when it says that, because there's a niche, that AI is going to be. And let me give you some background. I come from manufacturing. I'm an industrial engineer by education. I'm not sure that the people that I saw on the day in the life of a Googler TikToks are going to accept factory work. If those are the programmers that get moved out, in the same way that if there's a cutback in nursing, they're not going to turn into electricians. There's just not
Right.
that crossover between the personality types that go to those jobs in the first place. And I don't think, I mean, it's easy to say the opposite of learn to code, learn to plumb. I'm not sure that's going to land the way that folks are portraying that. Does anybody have any thoughts on that?
I'll add a point to that. I definitely agree with you for the most part. I think some people can, but not everyone can. And when you brought up nursing, it actually clicked in my mind. I think, you know, people think AI is going to take over everything. I don't see it that way. If anything, I more so lean on the side that AI will partner with humans, and where it's going to help humans be efficient. But I don't see it taking every job, especially with nursing in particular, right? I think nursing is a much more intimate kind of job that requires that human interaction. If anything, AI will assist the nurses and the doctors, make their jobs more effective and efficient. So I don't see that being cut. But the jobs that are more able to be more animated will be. But again, that's just my thought. But I think, if you truly are in need of a job and need to transition, I think you will be able to do it. But again, that's just my opinion. But I respect everyone's opinion here. But that's just where I see it.
Okay. Go ahead, Puzzled.
Oh, I just said thank you.
No problem. Thank you for your question, Puzzled. And Vin, I'm going to give you a chance to really hit it about it being a stock picker's market, which is my theory for 2025. This is going to be what I've been warning people, a very violent bear market, and most people haven't experienced that. Most people don't even know we were in a bear market from the 60s to 82 and don't read the history of what happened during that period, especially the monetary and currency impacts, which really impacted the lower and middle class and changed the structure of our economy at that time period. Now the question becomes the danger of what you're talking about with the index market. It's a stock pickers over an index market, if I'm reading you correctly. But do you see the risks with the over dependency on one, options by the average investor, by the retail investor, and two, ETFs? Nothing against ETFs. Some of them serve great purposes. GLD is fantastic if you don't want to hold the physical gold. However, and if you don't know about the miners, but you know enough to be dangerous, the miners is something you might want to look at. But when you start looking at ETFs of individual stocks, the idiocy of the company whose name I will not mention, his name is Saylor, who says Bitcoin is sufficient to get into the NASDAQ, into the S&P 500, etc. There's a lot of risk overhanging this market that will destroy index funds, in my opinion, and distort the true nature of the market. In 2025, when you say individual stocks, I say, just my personal opinion, natural gas, pipelines, robotics, some AI companies. What is your take on this first 6 to 12 months in the new Trump administration?
Yeah, so the first 6 to 12 months, I mean, these index funds, I mean, we don't really invest in them and all that. I just believe in creating your own portfolio that works best for you, that's best for you. If anything, invest in S&P 500, and that's it, to be honest with you. Like, if you don't have the knowledge, you put money in S&P 500, and then some money in some savings and bonds, and you leave it at that. I mean, it's a foolproof investment strategy for most people. So that's part one. So even though it's a stock pickers market, for most people, put it in the Vanguard S&P 500 or something similar, and then put some money in some CDs or high earning savings account or whatnot, and you'll be fine there. So that's a simple bit. Now all these other damn index funds, all these freaking things, ETFs are being created. That's just more of a way for them just to make money. A lot of it, to me, it's risky and provides really no value because, look, you can't if you truly believe in America and the American markets, you're not going to beat S&P 500. That's the top companies for the U.S. market. I mean, you're not going to beat that. And 97 or 98% of most money managers don't beat the S&P 500. So that's a fact everyone needs to remember. So if you're retail investors out there thinking, oh, you can do all these different types of index funds and all that, most money managers like myself, I mean, we do. We're the 1 or 2% that do, but most money managers don't beat the S&P 500. So that is lesson number one. Number two, in the next 6 to 12 months, I agree with you. Natural gas, I think nuclear is going to do real well. Oil maybe, but I definitely think energy in general will do well. And I think consumer staples when it comes to value, like Costco, I think continue to do well. Walmart. Some AI companies, again, like I mentioned before, real value AI companies. And then, yeah, that's pretty much about all we're looking at, to be quite frank. Because the problem with the Trump administration is there's so much uncertainty, right? And I hinted at before, with this past week on how things went down in DC plus the market, it is so uncertain. So it's really hard to understand which is going to trend, which industry, which companies. So that's why I always say stick to fundamentals. Look at companies that are going to do well no matter what the market is. And yes, it's going to go up and down, but look at companies that are providing products and services that are needed no matter what, right? This is why I mentioned public services, right? You need trash and recycling, right? You need water, you need energy, right? You need basic necessities. So those are the types of companies you look at. And if you want to get more venturous, look at AI companies that are going to do well, that are providing real value. So that's how we look at it. So we don't really, look at trends that much. We just look at, okay, which companies are fundamentally good. They're going to be around the next 5-10 years, regardless of what happens to the economy, and people need and want them. So hopefully that helps that answer that. And then again, if you're just a general investor that just dabbling a little bit, but you have a lot of money to kind of just sit on and don't want to take that risk, S&P 500 and CDs and all that.
Well, I'm sort of in the dry powder side on my bond funds at the moment, waiting for the stock market to go through its correction, and then we'll pick out those companies. So I'm on your side as far as value and predicting and picking companies which have a future versus those that look good on television. So 100%. If someone has some money they would like to invest with your company, please tell our listeners how to get in touch with you.
Yeah, so they can visit GarrisonFathom.com. I think we're going to launch a subscription for insights, but our fund, we have a high minimum. So unfortunately, we can't take retail investors, but we're going to create a subscription because of so much popularity, so that we can provide some insights of what we see, and they can take it and do what they want with it. So GarrisonFathom.com. Follow me on X. I am very, very vocal and animated, as you all can see, and that won't go away. And so hopefully that helps. So I wish we can take retail investors, but I'd rather just provide insights and some guidance and forecasts that can help them and then make their own decision. But we're just taking high net worth institutional.
Then, sadly, most people don't understand that the people who claim that they accept retail investors don't pay attention to their needs unless you have 9 figures. And that's the sad part about the large brokers. Unless you've dealt in that arena, they do not understand that, hey, I've got an account with XYZ at my bank. They could care less unless you have 9 to 10 figures in your bank account. And then you'll get the kind of personalized attention that you're talking about to take care of the actual needs of their investments. Then this
100%. Yeah, just real
it's crazy.
I'm glad you mentioned that, and that's the thing is that's why people have to be careful of who they listen to, right? Like with Willie and I, our passions. Look, we grew up dirt poor. We're family. Our family came as immigrants, and we've been lucky. Like we've done really, really well. And at least I'm willing to admit, look, I take high net worth institutional money, right? But I still have a passion for helping everyday people because I know what that's like. So even though we don't take retail investors, we're still going to care about it. Care about retail investors, and we'll at least provide you with insights that these other big guys won't. So, so follow us. It's free right now. I mean, I don't care. Like I'll give, insights out all the time. And we have a Medium account we post all the time on. But we want to help everyday investors, no matter who you are. Everyone deserves to have at least honest opinions and insights of what's going on in the market. And then you do what you wish with it. We're just not going to manage your money, but at least you can understand what's going on.
Vin, thank you so much. And please feel free to come back on anytime to share your insights, especially after we get through half of the first quarter, because I have a feeling after you hear some of the guests we have coming up and some of the events that you and I are both talking about occurring, things are going to get a little bit spicy as we head into March and the end of the first quarter of next year.
Absolutely. I really appreciate you having me on. I appreciate all your listeners. MacroEdge, I love you guys. We followed you guys for a while now. You guys provide great data. I think between you and Kabesi Letter, you two are my favorite ones. So I highly recommend you two. And I actually bring you guys up a lot when it comes to our investors. So keep doing the great work. And we look forward to collaborating more. And let's keep on rocking and helping people with providing reality and not what I call fake data or fake news from the financial world.
Vin, thank you so much. And believe me, we appreciate those compliments. Even the fact that you put up with my cranky old ass offering my bitter comments towards the Fed and beating up on them. For MacroEdge Radio, this is John Galt. Everyone have a great evening.